A single company, just weeks ago, dropped a $1 billion hostile bid on not one, but two publicly traded companies. This wasn't some quiet acquisition, it was a full-blown power play designed to create an industry titan overnight in 2026. How did a relatively unknown player, QXO, manage to shake up the entire building products distribution sector, sending ripples through competitor stocks like GMS and Foundation Building Materials? We're going to break down the audacious moves by QXO, led by industry veteran Brad Jacobs, and what exactly a hostile bid of this magnitude means for the target companies and their shareholders. We'll look at the specific terms, the market reactions, and the historical context of similar maneuvers, like Carl Icahn's 2012 battle for control of Herbalife. Stick around, because the lessons here reveal a lot about how power is consolidated in highly fragmented industries. What if I told you that in a matter of hours, a single company could try to rewrite the rules for an entire industry? Not through innovation, not through market share growth, but through a brazen, multi-billion-dollar play designed to snatch a competitor right out from under its shareholders. That's exactly what just happened. On December 11, 2023, QXO, a company barely known outside its niche, launched an audacious $6.05 billion hostile bid to acquire USLBM Holdings, the largest privately held pro-dealer of specialty building materials in the country. Now, for some context, USLBM reported over $11 billion in revenue in 2022. QXO, in its most recent quarterly earnings, showed about $1.1 billion. That's like a high school football team trying to buy the NFL. This isn't just a dry corporate finance story, it's a masterclass in aggressive strategy, and a stark reminder of how quickly the landscape can shift in any market. The attempted acquisition sent shockwaves through the building materials distribution sector, and it really highlights the intense consolidation pressure happening right now. And here's why it matters to someone thinking about their own investments. Understanding these power plays helps us recognize patterns in market behavior and how value is perceived and pursued by big players. You see, hostile bids are rare, especially at this scale, and they often signal underlying shifts in an industry. The target, USLBM, is a titan in its own right, with over 450 locations across 37 states, providing everything from lumber to roofing for professional builders. QXO, led by industry veteran Brad Jacobs, known for his aggressive growth strategies with companies like XPO Logistics, wasn't just making an offer, they were making a statement. They structured this bid to bypass USLBM's private equity owners, angling directly for the debt holders. The lesson here is that financial maneuvering can be just as impactful as operational success in shaping a company's future. Dropped a bombshell. A roughly $1.0 billion, all-cash hostile takeover bid for RXO. This wasn't a friendly chat over coffee. QXO went directly to RXO shareholders, bypassing the board entirely. For context, hostile bids of this scale, especially in a relatively stable sector like logistics, are rare. It immediately sent shockwaves through the entire logistics and freight brokerage sector. Now, who's behind this audacious move? The mastermind is Brad Jacobs, the CEO of QXO. If that name rings a bell, it should. Jacobs has a reputation for aggressive mergers and acquisitions. He's the serial dealmaker who built XPO Logistics into a powerhouse and then spun off GXO and, you guessed it, RXO. This latest move felt almost like a reacquisition, a familiar face coming back for what he knew intimately. RXO, the target company, is no small fry. They're a significant player in the asset-light logistics and freight brokerage space, spun out from XPO in November 2022. Jacobs' bid, valued at approximately $18.25 per share, represented a significant premium over RXO's trading price at the time. The market reacted instantly. RXO stock, ticker RXO, soared on the news, jumping over 25% in a single day. The broader logistics sector also saw tremors, with other players like C.H. Robinson, CHRW, and TFI International, TFII, experiencing notable price movements as investors started speculating about a wave of consolidation. The lesson here is that aggressive, unsolicited bids can profoundly reshape investor perceptions of an entire industry's future. This wasn't just about a single company's valuation, it signaled a potential new era of aggressive, inorganic growth strategies across the entire supply chain industry. Which brings us to Brad Jacobs' Playbook. Building a logistics empire. Is QXO? And more importantly, who is the mastermind behind this audacious move? The answer to both is Brad Jacobs, a name synonymous with building multi-billion-dollar empires out of fragmented industries. Jacobs isn't just an investor, he's a serial acquirer with a proven playbook. His vision for QXO is clear. Create a tech-forward logistics powerhouse through aggressive inorganic growth. We've seen this strategy before with him. He took United Rentals from a concept in 1997 to a company with over $10 billion in revenue. He built United Waste Systems into the fifth largest solid waste company in the U.S. before selling it for $2.5 billion in 1998. Then came XPO Logistics, where he executed a staggering 17 acquisitions in just 50 months, growing XPO from a $150 million market cap to a $17 billion giant by 2018. His QXO roll-up strategy involves acquiring established companies, integrating them, and then leveraging technology to achieve massive scale and operational efficiency, aiming for rapid market share capture. RXO was a prime target for this very reason. It's the third largest full truckload broker in North America, boasting a robust customer base and an established technological infrastructure. Think of it. QXO gets a ready-made asset, already generating significant revenue, to bolt into its structure. Why now? The logistics sector is ripe for disruption. It's a $1.5 trillion industry, still largely fragmented, with significant technological advancements available to those who can integrate them. A well-capitalized, aggressive player like QXO, led by Jacobs, sees this as an opportune moment to consolidate and dominate. The lesson here is that a strong leader with a proven acquisition strategy, backed by capital, can significantly reshape an industry. But RXO wasn't just going to roll over and accept this hostile bid. Already seen this playbook with XPO Logistics, a company he grew into a global giant before spinning off its less-than-truckload business as XPO and its freight brokerage as RXO. But RXO wasn't just going to roll over. The RXO board of directors swiftly and unanimously rejected QXO's $1 billion offer, labeling it opportunistic, not credible, and a significant undervaluation of the company. To understand the gravity of this, imagine a friend offering to buy your house for 60% of what you know it's worth, right after you've invested heavily in renovations. That's the sentiment. RXO's management, led by CEO Drew Wilkerson, argued QXO was attempting to capitalize on what they saw as a temporary dip in RXO's stock, rather than offering a price reflective of its long-term intrinsic value and future growth potential in the evolving logistics market. They pointed to RXO's significant scale, its robust technological platform, and a diversified customer base as reasons why the offer failed to adequately value the company. More than just a verbal rejection, RXO immediately deployed a powerful defense mechanism. A shareholder rights plan, commonly known as a poison pill. This isn't just an abstract concept, it's designed to make a hostile acquisition prohibitively expensive. In RXO's case, if QXO, or any other entity, acquires 10% or more of RXO's outstanding common stock without board approval, other RXO shareholders would be able to buy additional shares at a discounted price, effectively diluting the acquirer's stake and making the takeover significantly more costly. This move alone sent a clear signal that RXO was prepared for a protracted fight. Furthermore, the board highlighted what they saw as significant regulatory hurdles from the Department of Justice and Federal Trade Commission. Given Brad Jacobs' deep history with XPO, which spun off RXO, antitrust concerns were a very real consideration. The lesson here is that even the most audacious bids can meet an unyielding defense, forcing potential acquirers to re-evaluate their strategy. This standoff immediately created ripple effects throughout the broader logistics and freight brokerage sector. This hostile bid sent shockwaves far beyond just QXO and RXO. Think of it like dropping a big rock in a pond, the ripples spread everywhere. Immediately, other logistics and third-party logistics, or 3PL, companies started reassessing their own valuations. Companies like C.H. Robinson Worldwide, ticker CHRW, and Landstar System, ticker LSTR, likely saw their boards and investors asking, "Are we next?" Is our stock price reflecting our true value, or are we vulnerable? We saw this play out in 2024 when Roadrunner Freight, a large LTL carrier, was valued at over $1.5 billion in a private transaction, highlighting the appetite for scale in the sector. The Brad Jacobs effect here is huge. His proven track record, turning a small waste hauler into the multi-billion-dollar waste management, WM, and then building XPO, means when he makes a move, the entire industry pays attention. This isn't just one company trying to buy another, it's a signal that aggressive M&A, even hostile bids, is back on the table for fragmented sectors like logistics. It could very well embolden other private equity firms, or even other well-capitalized strategics, to pursue similar plays. We've already seen a lot of M&A in logistics. Think about Maersk's acquisition spree, buying Senator International and LF Logistics in 2021 to 2022 to bolster its end-to-end supply chain capabilities. What this QXO bid for RXO really does is put a spotlight on how logistics companies are valued, especially those with strong tech components. RXO, with its RXO Connect digital freight marketplace, offers tech-driven efficiencies. QXO's $1.0 billion all-cash offer suggests Jacobs believes the digital advantage is currently undervalued by the market. This might force the market to re-evaluate what constitutes a fair price for these tech-enabled logistics assets. The lesson here is that in fragmented industries, a bold move by a recognized player can completely reset valuation expectations and kickstart a wider consolidation trend. This could lead to fewer, but much larger, players in the freight brokerage space, potentially impacting pricing dynamics and service levels across the entire supply chain. So, with RXO digging in and Jacobs clearly not backing down, what's next in this battle for logistics dominance? So, what's next in this high-stakes game of logistics chess? Brad Jacobs, with QXO, faces critical decisions. He could sweeten his initial $1 billion offer, perhaps moving closer to the $2.0 billion to $3.0 billion range some analysts whisper is a more realistic valuation for RXO. Or, he could launch a proxy fight, attempting to sway RXO shareholders directly. Walking away seems unlikely after such a public move, which would pressure Jacobs to demonstrate value to his QXO investors. On RXO's side, having emphatically rejected QXO's bid, management is now under immense pressure to prove they can deliver superior shareholder value independently. This could involve accelerating growth, exploring strategic partnerships, or even attracting a white knight bidder. Beyond the immediate players, regulators will scrutinize any proposed acquisition intensely for antitrust implications. Given Jacobs' history of building XPO Logistics and spinning off RXO, questions about market concentration would be significant. This makes a clear path difficult without concessions, potentially eroding the very synergies QXO seeks. Furthermore, integrating two large logistics companies with different operational systems and cultures is incredibly complex. If not managed carefully, these challenges could easily undermine projected synergy benefits. Regardless of whether this specific bid succeeds or fails, QXO's aggressive play marks a turning point for the entire logistics industry. It signals a new era of intense competition, rapid consolidation, and potentially significant shifts in global logistics leadership. Even when a direct takeover fails, the ripple effects can fundamentally reshape an entire sector. QXO public move. The lesson here is clear. Brad Jacobs isn't afraid to make a statement, and his ambition could redraw the lines of the entire logistics sector. What we've witnessed with QXO's bid for RXO isn't just about one acquisition. It's a seismic tremor indicating a new era of consolidation in logistics, driven by leaders with a clear vision for tech-powered efficiency and market dominance. This kind of aggressive inorganic growth strategy, reminiscent of what we saw with Berkshire Hathaway's earlier acquisitions, signals that even established industries aren't immune to rapid, disruptive change. It tells us that companies, regardless of their current size or market cap, need to constantly evaluate their strategic position and valuation, because a QXO-like offer could land on their doorstep next. The ripple effect on CHRW and LSTR, even without any direct bids, shows how quickly the perceived value of an entire sector can shift when a major player makes a bold move. This isn't just a hostile takeover attempt, it's a blueprint for how a single, determined player can force an entire industry to reevaluate its future. Have you ever seen a hostile bid play out in a company you were invested in, or perhaps even worked for? What was the outcome for shareholders and the company? Drop your story in the comments below. And if you want to understand how these massive market shifts impact your personal portfolio and what this means for someone looking to build long-term wealth, make sure to subscribe. If you like this breakdown of market forces and strategic plays, my deep dive into how Ray Dalio's all-weather portfolio fared during the 2022 rate hike cycle is exactly the next thing you should watch.